Hello and welcome to the DIY Investing YouTube channel. We are working through every company in the S&P 500 and today is Biogen Incorporated, ticker BIIB. Over the next 5 minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. We'll dive right on in. This company is in the biotechnology industry and it has a market cap of $28 billion. When we look at the business description, they discover, develop, manufacture, and develop therapies for treating neurological and neurodegenerative diseases. So they provide all these different treatments. It's clearly a lot of biotechnology treatments. That gives us enough information to keep going. Now, return on invested capital, I like to look at first, and we can clearly see that 1 year over the last 20 years, they have lost money, which is pretty good. That means 19 out of 20 years they have made a profit. That's a very good sign for me. Now, they had minimal profits in the first 3 years here. Basically, these first 5 years seem to be not very useful. But starting in 2004 all the way up to 2019, they had a steadily improving business. You can see growing returns on invested capital over that time period, but they've been a little bit rockier and more cyclical since 2014 when they hit a high of 28%, and in 2019, 30%. They've been falling since then. Now, one of the risks with these types of companies is that when you have a biotechnology company, you're going to have very strong returns on invested capital, very high gross profit margins. You see these 10-year median returns, 86%, free cash flow margins, 30%, EBIT margins, 42%. These are all amazing world-class numbers. Why? Well, you have patents. Your patents are protecting your products. Now, what's going to happen is while your product's under patent and they're growing, you're going to see these steadily increasing returns. But then as soon as you hit a patent cliff and you go off patent, you start to see declining returns. And so there's a cyclicality to the product cycle. And those patents make these companies really good businesses while under patent. But when you lose patents, your revenue drops and that really can hurt the business. So they're difficult to assess in that sense. But overall, when under patent, these are some of the best companies in the world. The problem is patents don't last forever. They usually have a 10, 20-year life. Maybe you're able to only commercialize it for 5 to 7 years because you spend the first 12 years doing trials. But you can clearly see what's happening here is all the way up to, you see this 2019 number, they had $14.3 billion in revenue, which they'd grown from $5.5 billion in 2012. So great returns up till then, but then you had declining revenues the last 2 years, which is what's really driving these losses in return on invested capital. All I can guess is that this is due to loss in the patent cycle because beforehand you had very strong gross margins of this 86% and then it dropped down to 80% in 2020. You're seeing these more competitive environments, which would be normal for a company that's now facing competitive pressure where they didn't have it before. So you can see that they basically 6x their earnings from $5 per share to $31 per share, and then that's declined down to $10 per share. So they lost 2/3 of their earnings power in only 2 years. This is the problem I have with these types of companies. They have all the characteristics of what looks like a great business, but it's because they don't face any competition for the majority of their life cycle, and they face severe competition immediately following that. Makes it very hard to assess these companies. Now, when we just look at the statistics, everything's going to look good. 10-year median returns, return on equity 31%, return on invested capital 21%. But when you compare that to the last year, return on invested capital is 8.4%, return on equity is 14%. These numbers are acceptable to me. I would be thrilled owning a business with these numbers. I'm not thrilled owning a business with these numbers of 8%, 14%. So it's hard to know, is 2021 more like what I can expect in the future, or is 2019? Or is it going to be even worse in the future than 2021 because the last 2 years have had declining revenue? I don't like buying businesses with declining revenue. And so for me, I'm probably going to pass this business, but it's worth doing a little bit of a deeper dive. If you're enjoying this content so far, please hit that like button. Please subscribe and ring the bell so you can get more content and uploads each and every week on investing, looking at individual companies, figuring out how to analyze them, how to make better investments. So you can see the PE ratio here is 19.8. That's pretty reasonable. For a company with these level of returns, that's actually a very good price. PE of 20 for these level of returns is great. Now, for what's happening over the last 2 years, I'd want a PE below 15. I'd maybe want a PE below 10, and it's because the revenue is declining now. And if the company is declining, then you can't bet on growth. You can only bet on declines, which means maybe a PE of 8 is more acceptable. And so it's very hard to value this company as that is. And one of the things you're seeing is assets are growing faster than revenue, which is a little concerning for a business like this because I'm not sure why that would be. We can see your revenue kind of growing over time here. So they have been buying back shares. You do like to see that. And so I like that they're doing share buybacks, dropping from 238 million shares to 149 million. Let's look at the balance sheet because I want to understand what's going on with these assets. Goodwill. So this is a big piece. They've been doing acquisitions. The fact that you have these intangible assets and the goodwill is going up over time is a big driver. Because if you simply look at PP&E, your property, plant, and equipment is only $3.8 billion, but that's like 15% of your total assets. A bunch of your assets is stuff like cash, accounts receivable, inventory, goodwill, intangible assets. The tangible asset base here is actually pretty small, so your returns on capital much higher. But you have to take into account goodwill because doing regular acquisitions is a pretty ongoing process for a company like this. So you can't just simply ignore it. Let's look at their debt. So they've 6x their debt over the last decade, which is a little concerning, going from $1 billion to $6 billion, but it's not an extreme amount of debt. Cash flow. You do see positive cash flow from operations every year for the last 10 years, which is very strong, very good. And so you see these strong, steady buybacks. Now, you do have stock-based compensation every year, but you're in that $100 to $200 million range of stock-based compensation, while you're buying back, anywhere from 500 million to 5 billion shares of buybacks. And so you're making huge level of buybacks, reducing your share count over time. Now, you do see they're also having steady acquisitions, and that's what's driving that goodwill up. That's what's driving those intangibles up, and that's where those assets are going up in cost. So for me, I would pass on Biogen. I really don't like biotechnology companies because they have this cyclicality. It's very unpredictable what their revenue is going to be once they go off patent. And sometimes you face this where you lose 40%, 30% of your revenues within 2 years, and that absolutely destroys your returns on capital, destroys your return on equity. It makes it very hard to value. So for me, Biogen's a pass, not because they don't have good bones, they do. It's just very hard to value it. And so if you're experienced in this area, it's something to consider. But if you're not experienced in pharmaceuticals or biotechnology, then I would consider it a pass. So if you enjoyed this video, please hit that like button. Please subscribe so you can get more great investing content as I upload new videos each and every week on investing. Thank you for listening. And until next time, stop paying fees, start building wealth.